Hey guys, Stockaholics, thanks for being here today. Is oil heading to $100 or to $20? I see a lot of videos on YouTube where there are people claiming that they know where oil prices are going within a designated time frame. Maybe some of them do. I certainly would not fall into that category. I don't know where oil prices are going 6 months from now or tomorrow, but I do know that as the time increases, the probability of these extreme prices of $100 and also $20 is very high. So that's why I have answered this question with an ambiguous yes to that. I wanted to talk about oil prices and how they affect my oil investment strategy. I'm going to talk about three things in this video that I thought were really interesting. That is the oil supply cost curve. So the prices that different producers of different kinds of oil, the cost that they can break even at. And there's been some changes that have been happening over time that I found very interesting. I'm also going to be talking a little bit about shale oil, my opinions on that. And I'll also be talking about my investment strategy, especially when it relates to extreme pricings, although some people might argue this is not as extreme as some people predict the price could go. But that's what I'll be talking about in this video. This is the global liquids cost curve 5 years ago in 2015, according to these guys, Rystad Energy. So what we're looking at on this chart is essentially the average price of oil where producers of different types can break even. So the cheapest type of oil production out there are producing fields, and in 2015 the average cost that these companies could break even at, or these producers could break even at, was approximately $29. And then in 2015 the most extreme level of pricing for these companies to break even at in terms of oil pricing was oil sands, right? So essentially the way I see this is the lower you are on this cost curve, the less risky your business is, the more cyclically strong these types of business are relative to their competition. And then the further you go out on this curve, the more risk you are assuming, but also the more potential returns. Now I would also define generally the further you are up in these cost curves to be bad businesses. I would suggest that the likelihood that these kinds of businesses survive for very long periods is unlikely, but there is there's the potential for outsized returns. I'd also like to mention in the United States, a bunch of these offshore kind of riggings, they went bankrupt last year, for example, in when the COVID situation started and oil went negative. These guys many of them went bankrupt. They couldn't stomach the volatility in the oil price. Okay, and this is a similar production kind of cost curve taken from the same guys, but instead of in 2015, it is a cost curve from 2019. And one of the things that stood out to me right away when I was looking at this is that for most of these producers, not all of them, but for most of them, the average cost of production over time has actually been going down. And I don't think that I can explain entirely why this happened, but I would hypothesize, or I would suggest that it is largely because of technology. Kathy Woods is a big deflationist. I would actually fall in a similar camp. I think that technology might be having the potential to be driving down the cost of production over time too. So I thought that was a really interesting thing to notice. However, the cost curve itself doesn't change much, right? So if these producing fields, they're still able to produce oil cheaper relative to a lot of their competition, these guys further out in the cost curve still have the potential to be a lousy business, whereas these guys still have a distinct advantage. But I thought this was interesting because it likely suggests that over time, oil prices are actually likely to decrease. I wanted to talk a little bit about fracking technology. So fracking is actually really interesting to me because it transformed the United States from a net importer of oil to actually a net exporter of oil over the last decade. But when this technology was first invented, there was a lot of optimism with the, the technology, and there wasn't a lot of, I guess, input into or thinking about the actual if this thing was actually going to be profitable at different different kinds of oil pricings. Yeah, so largely this technology, like most of those other technologies further out that cost curve, over long periods of time they tend to not be very profitable, right? And over the last decade we've seen the investment in this kind of technology been shrinking over time, when there's been the realization that largely it's going to be hard to make this thing profitable for most oil prices, right? But I'd also like to suggest, like we saw in the last few slides, I would imagine that fracking is a lot like other kinds of oil production as well, and it's more likely to get more efficient over time, right? And although that they probably won't ever be as cost competitive as other types of technology in terms of oil production, that is something I think that's kind of important to keep in mind. And then I also hear a lot of oil bulls out there saying, well, you know, fracking is dead. And I would suggest that that's unlikely, right? I think that it's more likely that fracking is going to just be another type of oil production out there that remains out there. And it'll especially tend to increase production in this kinds of technology once it becomes economically viable, once oil prices remain high over a long period of time. And I think you can kind of see that if you look at this graph here. This is the US nationwide frac spread count. And if you look at this graph in 2020, you know, this thing went absolutely off a cliff. Once, you know, oil prices went negative for a few months time, or maybe a month, right? Or no, actually, no, it didn't. It was very low for a long period of time, and it actually went negative for a very short period of time, right? But what you notice is once those oil prices started to recover, and now that we're in these $70, $75 a barrel, you see more and more of these kinds of frac spreads coming online. And I would suggest the longer oil prices stay high, the more of these kinds of marginal production, for example, shale, is these technologies are not dead. They'll simply be those kind of swing producers, and they'll come and produce oil when it becomes economical to do so. I guess the main point I'm trying to drive home in terms of the supply side of the equation for oil prices is that oil itself, at least under normal circumstances, and we're going to get to some extrinsic circumstances a little bit later, under normal circumstances, the supply of oil is sufficient to meet demand. So that means that it is under a healthy oil market. It is largely range bound between the different range of producers and how much they can supply at different price intervals. Also wanted to logic our way through oil demand for a second. That's the other, I guess, determinant of oil pricing. There's certain institutions out there that would suggest that we are or rapidly approaching peak oil. I wouldn't fall into that camp, but I also certainly wouldn't fall into the camp that says that oil demand is very likely to rapidly rise either. The main parts of the world where we are going to see oil demand growth is through emerging economies, and they are growing very rapidly. A lot of them are hitting their S curves. And I expect that to gradually increase overall demand. But the main reason I don't think oil demand is going to go parabolic is because of some of the things we noticed in the supply side in terms of pricing. The first reason is technology, right? We know that engines, internal combustion engines, over time, and vehicles and transportation and all these things, over time they've been becoming more efficient, right? The other part of that is that along with technology in the West, oil demand has largely been stagnating in a lot of places. There are also some places in the West where oil demand is actually slightly decreasing. So in terms of overall oil demand, the growth that we would have to see in emerging markets to complement the decline that we are seeing in the West would really have to be explosive. And for that to happen in terms of in terms of supply not being able to ramp up production fast enough, to me that seems less likely. Okay, so when we think under normal market conditions in a healthy market, if demand is likely increasing very slowly, but it is increasing, and we also think that oil supply is likely going to be able to keep up with this, the normal determinant under a healthy market is going to be that cost curve from the supply side. In my opinion, what is a healthy price for oil in the long run? Probably somewhere between $50 and $60, somewhere in the middle to the upper end of that cost curve for a lot of those oil suppliers to break even, or on the very high marginal end, or to actually be losing a little bit of money, right? But we don't work, or the world we live in doesn't work as smoothly as we might hope, okay, in a lot of cases. And there are what I like to define as extrinsic events that happen all the time in oil markets, right? So the main thing that would either cause oil prices to go very low or very high are extrinsic events. And these are always temporary in nature, and they provide incredible investment opportunities, okay? And I'll explain a couple of the ones that are most likely to cause either prices to go very low or high. So first of all, in my opinion, the most likely triggers to oil prices would be exogenous supply side events. These are not predictable and generally not a good base investment case. So often you'll hear these guys go on the media, CNBC or wherever, and they'll say oil prices are going to $100. There's been an underinvestment, yada, 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 right? Under normal conditions, unlikely, but there are always factors that are unpredictable and unknowable that will cause this to happen eventually, okay? On one hand, although OPEC has been very compliant over the last year or so, actually excessively so, some oil producing countries actually produced less oil willingly than their actual quota was. So I thought that was very interesting. But historically, this hasn't always been the case. Eventually, although the game theory optimal solution for these guys would be cooperation, eventually something always breaks down. And we first saw an example of that when the COVID situation first started, when Russia and Saudi Arabia got into a spat and they absolutely just wrecked the whole oil market, right? But these kinds of things, when they happen, they actually always provide an investment opportunity, because it is in nobody's interest for these kinds of events to continue. These guys eventually have to work it out, because everybody loses when oil prices go very low. So because we know that these OPEC disagreements are always likely to be temporary in nature, correlates very highly to lower than average stock prices. Those usually tend to be great buying opportunities, right? There are also events that happened due to human nature, and those are conflicts, right? So if we think about the Middle East, a lot of oil comes from that place in terms of world oil supply. It's notoriously a volatile region. And every so often, I would expect that a conflict is likely to break out there or some other place in the world, disrupting oil supply. And just like the OPEC disagreements provide a buying opportunity, these kind of events actually provide a selling opportunity, right? If we know that one of these is likely to happen in the future, just like OPEC disagreements, war tends to be, the parties involved tend to not like to be in conflict for very long. It tends to not be very palatable, I guess. So just like those OPEC disagreements are temporary, so too does war and the supply disruption. So those events, when they happen, which cause oil prices to go very high, provide selling opportunities. Okay, so, and that brings us to my personal strategy in oil investing. And this is not investment advice. First of all, when I think about a good cyclical company, that's one that's going to have on average, higher margins than a lot of their competitors. So in terms of oil producers, that's going to be companies that are lower on the cost curve. I mentioned a company called Lukoil. They are, I think, in the 70th percentile of profitability compared to a lot of their competition. They've also got very low debt, and they also have an outstanding dividend. So for me, I really like these, in my opinion, safer-ish kind of plays compared to the more marginal producers out there, right? But in terms of an overall strategy, I kind of came up with this, yeah. So every year that passes, there is a non-zero chance of either an oil collapse or an oil price surge outside of a permanent secular change, okay? And this is on the top, chance something that will F up in the oil industry, either towards the positive or the negative. And on the bottom here, I have time, okay? These probabilities may not be accurate. These are just rough estimates by myself, right? So I think that overall, every year for something really bad to happen, maybe there's a 10% chance. But I know the further time goes out, the chance of one of these things happening is probably 100% likely in the real world, right? So what that means is these provide tremendous buying opportunities and tremendous selling opportunities, and they always happen. The first, by the way, I bought Lukoil during COVID. I was like, okay, this is an extrinsic event. This negative oil price, this isn't this isn't healthy. This can't last. It's not beneficial for anyone, right? And I know that at some point in the future, there's also going to be an event that happens where it causes oil prices to explode, and everyone's going to be very profitable, and these tend to correlate very highly to market euphoria, equities reaching overvaluation, and for me, that'll be when I sell. Anyway, I hope you guys found this video interesting, and I'll see you guys soon.